This is a money must read with Gabriela Santos of JPMorgan, and the last sentence is her money sentence. For a 65-year-old couple, there's a 50% chance that one of them will live to age 90, you're looking at me, or beyond,
no one's looking at you.
35 years in retirement. The solution, saving and investing more. This is Peter Orszag over at Lazard 101. The biggest problem with ERISA 74 is we all thought we could have put a little bit of money in and we'd be fine. And you're front and center in this. Okay, how much do we have to put in?
So I think that the important thing is really to plan ahead. So it's not to plan to get to retirement, but it's to plan to get to and through retirement. And so just the time horizon is very different, I think, than people normally think about. It's having enough wealth and income gains to get you through 35 years plus of a dignified, enjoyable retirement. And I think this is where sometimes personal behavior can get in the way. Because on days when the market is down, it may be tempting to say, look, I have this long-term plan, it all sounded good at the time, but let me get out, I'll get back in. The market actually tends to have good days clustered around the worst days. And if you just miss the 10 best ones over the last 25 years, you could have cut your return in half. The other thing that's important to do is also to change your allocation over time. So, of course, as you're younger and if you have a certain risk appetite to take on more risk, but as you get to retirement and through retirement, to really think about that glide path of the riskier assets coming down and your more income focus going up.
So I'm glad you mentioned that, because I know Tom doesn't want to retire because he's having too much fun, and we just locked him into Bloomberg Money for the next couple of years. How does he preserve his capital without losing it all to inflation? I mean, the traditional safe plays like treasuries didn't work in 2022, didn't even work in late March. Gold is like a meme stock, so they're not reliable.
Yeah, so I think the number one thing is this difference between saving and investing. So cash isn't always king. Actually, cash rates are now below inflation, but even when they were above inflation, it can only do so much for you. The real growth piece is going to come from other asset classes. If you look at corporate credit, if you look at equities, if you look at private markets. Then when it comes to the actual keeping up with inflation, I think what's important to think about is actually a lot of asset classes like equities are nominal asset classes, right? It's about the volume and the price. So inherently, there's a certain inflation protection there. But if you think directly about diversifying inflation shocks, that's where bonds can only do so much for you. They can hedge against recession shocks or demand side shocks, but they're not very good at inflation shocks or supply side. So that's where we've really thought about diversifying the diversifiers. There's no one magic solution.
I like that.
You can look at a variety of things, whether it's options to directly hedge the downside. Private markets have a lot to offer, like real estate, infrastructure, transportation. So there's a lot to do, but it's very different than the post-GFC period.